Hello, everybody. It's Dr. Rick dropping in on you. Hope everybody is having a great start to your week. As for me, I'm blessed. I'm excited about what's coming. Hope that you guys are excited as well. Look, it's Money Monday. Money Monday. And today we're going to talk about, I'm going to give you some tips on risk assessment and how to manage risk in investment in business. But I want you to pay attention to the mindsets as much as it is strategy, because it applies to not just the stock market or not just business, but risk evaluation in general. But specifically when you're talking about investing, there are some things and some mindsets that I'm going to talk about real briefly. Look, after watching this, or anytime during the process of watching this, you see it to be something of value, something of interest, click the like button, click the share button so that other people can benefit from it. Follow it and subscribe to the channel or the page so that you can get more valuable insight and information as we move forward. Also, don't forget to check the description box, the text box, for offers and resources and ways that you can use information and gain access to resources to help you advance in the areas of life, especially in business and finance and personal development. So on that note, let's get started. This segment is brought to you today by the Legacy Wealth Academy. Now, risk management. I'm gonna give you 5 basic tips, and in those tips, I hope that you can gain some insight. Again, it is so immensely important to develop a clear and lucid understanding of investing, because I believe, number one, the biggest problem we have as a population in general, and if we're talking about Black specifically as a group, is we are consumer minded by nature. We're literally programmed by all the information and the flooding of information and the drive to hit our pleasure centers and dopamine drives. We are literally driven to buy without evaluating what we're spending our money on. Both the consumer and the investor spends. The difference is the consumer spends on things that have no intrinsic long-term value, tend to depreciate with time, where the investor spends on instruments and assets that literally appreciate in value over time. Both cross lines, both, at times do both, but the predominant thought is things make me important, things make me successful, versus the power I build with my wealth lays and paves the path for fulfillment in life for me and those who descend from me, my progeny. That's the basic difference. So the idea is, moving into this, another thing that I want to get into before I move forward is the importance that you understand that when we start talking about investments, the reason we're talking about risk management is there's no way to invest without risk. And in the few opportunities you may get because someone covers you, your spread is being covered by someone. So that's still a risk. They're eating the risk for you. So anytime that you get that opportunity and you trust it, take it. But the whole idea is you have to understand that there are risks involved with investment. Your job is to manage risk to reduce the risk of loss without becoming risk averse. What is risk aversion? Risk aversion is a person who is so afraid to take the risk that they miss the opportunities for growth. And by doing so, they literally actually put themselves back. So by not taking a risk, you actually risk your future. So here we go. The first way that we'll go, the first tip number 1, reevaluating portfolio diversification and asset allocation. You heard it a million times. if you even whether you've thought about being a serious investor or not, you heard it a million times. Don't put all your eggs in one basket. What does that mean? When you place all that you have into one opportunity, you're riding the up of that opportunity with the hopes that nothing ever goes wrong. The problem is something always goes wrong. So how do you hedge against loss in a situation like that? Asset diversification, investment diversification. What does that mean? That means that I'm going to find multiple things to invest in, and I'm going to strategically invest in it so that the percentage that I have in each investment works to hedge against loss in any particular area. So I can lose in any one area, maybe even two areas, and as long as the other areas are holding up, I'm going to be okay. So what happens is, but outside of catastrophic market collapse where everything goes bad, I should be able to systematically systematically protect to a certain extent. So asset allocation. What is asset allocation? It's where I'm going to allocate my investment. It's where I'm going to put the assets of funds I have into mechanisms that produce growth. And you're going to hear about the management, the on-hand cash situation in a minute, but I wanted to get to that. So the idea is diversification. You want to invest across assets, not just in one industry, definitely not just in one company. But even if, say, an industry is banging and you got multiple companies that's doing well, and you can literally get the information and the financials and everything that you can get on these companies are great, especially in the tech industry. You're going to get a lot of that right now in the tech industry. So you can get in that, but don't sit up and say, okay, I'm putting everything in tech, because anything can go wrong. Some things will go wrong. Tech is up on an upswing right now. It's a great place to go, but it shouldn't be the only place you go, because there's always other ways you want to diversify, because you don't control the market. And talk to Warren Buffett, talk to David Swenson, talk to Jack Vogel, talk to, I mean, any of these heavy hitters that literally make their money investing. I'm not talking about the tech guys who have gotten rich. I'm not talking about the retail guys, the Bezos and the Gates and all those that got rich off of their ideas. I'm talking about people who literally study companies and determine how to invest in companies and invest in businesses and all these other things. And every last one of them says you can't predict the market. That's why I am not an advocate for actively managed mutual funds. I prefer the passive managed mutual funds you get in an index fund. Plus, it's compound growth. Can't miss with that. Long term, especially. So that's that. Next, we're going to move to lowering your portfolio volatility. To me, one of the best ways to lower your portfolio volatility is reduce cash on hand. Now, obviously, you got to have cash on hand, especially running a business. You know, you got to have cash on hand for bills, for expenses, and all these things like this. But you got to understand that there are very few instruments that hold cash that keep them readily liquid, that will allow you to keep your money there and it grow at pace with inflation. What do I mean by that? Your checking accounts and your traditional checking accounts and savings accounts that are out there that you would normally keep your money in aren't paying enough in interest percentage wise to keep up with inflation. What does that mean? If I put $1,000 into an account and it pays 3%, but inflation is moving at 5% over time, that $1,000 stops being $1,000 in value, and it means it buys less. Whereas, and I could put it in, say, for instance, a passively managed mutual fund or an index fund where it's producing 8.2 to 10% annually compounded, and it will grow faster than inflation and produce growth. In other words, I'm not losing money by holding on to it. I'm doing it. Now, obviously, it's not as liquid. I just can't go out and pop a card and pay for something. If it's in a fund, there has to be an exchange, and it has to be done during the time that the stock exchange is open. But the stock market is open. So there are all these different things. But one of the things that to me is the easiest way to reduce volatility in your portfolio is lower your cash on hand to the point that it's uncomfortable. It's going to catch you because I get caught. But what it will do is stop you from getting blew up, because here's the problem. The US dollar is under assault in so many different ways right now. If you're operating and you're moving and you're handling your funds and you're in a US driven economy, so your money is based on US dollars, look, the dollar is under assault. The bricks are acting up and doing things, and you got to expect this. There's so many moves being made on the US dollar, and not to mention inflation that's driving down the value of the dollar. So you can buy less. So you want to put your value into something that's growing, that can translate outside of what the US dollar does. So you need things of value, precious metals, precious jewels, funds outside of the US, just in case. So again, this diversification goes in so many different ways. You got to really, really, truly think and be strategic. Again, one of the reasons why you need to educate yourself on what's happening financially and globally. The reason we are where we are isn't because we can't, it's because we don't know. I've said this over and over again. We are in a place because we don't know how things work. We literally are fed ideas and information. We actually wake up every day thinking that we can three job our ways to financial security, that we can work 18, 19 hours a day and we're going to break through. But that's not the path. It's never been the path. That's the path they get you, because everybody you're working for, when you're working those three jobs, that company, the owner of that company, and the higher ups in that company are the one benefiting from your labor far more than you are. Now, you may be getting some things paid. You may have to do something. This isn't taking a shot at anybody. Sometimes you got to do what you got to do. I get it, and I applaud you. But that can't be your life's plan. That cannot be your life's plan, because it doesn't end well. It's never ended well. If it was, there'll be a whole lot more black rich people, because we don't have a problem working, despite the idea and the notion always pushed that we're lazy. We'll go out and work three jobs. Three jobs isn't how you get wealthy. That's how you make three other companies more money. Because guess what? If I'm paying you X amount of dollars, you're making me four more than I'm paying you. That's just basic business sense. So you got to understand your value in the market. One of the things that you need to do is understand you are an asset. You're your greatest asset. Your mind is the greatest part of that asset, and you are an asset. People hire you because you're an asset. Now you have to ask yourself, what value do I bring to this industry where you work, whether you're working in Popeyes or you're working at IBM, Halliburton, wherever you're working. You have to say, what am I bringing to the table? What is my actual market value? And what am I getting in percentage wise of that market value to have this opportunity? Because what you understand is the company gives you an opportunity, and they're going to use your gifting to do what they need to do, but they're giving you opportunity to use your gifting and to use your value in a market that they're providing. Now you have to ask yourself, is it a way into this market outside of this company? And what would be my market share if I did it myself? Would I be making more than I'm making now? Would I be making the same? What type of freedoms would that create for me? All of these are questions that you should be asking yourself, because these are the true things that are going to determine your true wealth and your true value in any marketplace over time. Okay, so then the other part is rebalancing. You want to lower your cash on hand, but you also want to do rebalancing. We talked about asset allocation and diversification. Okay, you diversified, but you need to do rebalancing every so often. You've got to come up with a strategic period in which you're going to rebalance. What that means, you're going to sit down and you're going to look at how all of your assets are performing, and then you want to determine where you're putting most of your money percentage wise, and from the highest to the lowest. And it changes because different companies, different industries, different times of the year, different markets, seasonal. You have to be aware of that and on top of that, and it's your responsibility to do that. But you want to do that. Investing consistently. I'm not real big on day trading, buy high, sell low, all that stuff. I'm real big on finding good, solid assets that perform over time and investing and taking the long-term growth process. There are a lot of day traders that get paid a lot of money because they know how to get in and get out. The problem is, because you can't predict the market, you sometimes get caught. I say this all the time: day trading is one of the fastest ways to get rich, but it's also one of the fastest ways to go broke. And it is a hard to manage risk. And because there's this volatility and shifts and things nature, you start out, the day's great, you're going fine, you're all in, and you're not paying attention. Somebody blows something up in another country, triggers a global response, markets get crazy, you lose. Before you look up, boom. That's what happens in day trading. Long-term trading, you go through all of that. You see it happening and you're not sitting up, you're not getting emotional, you're not getting caught up in what's happening. You're trusting the decisions you made long term. So, but you got to be consistent. You got to be consistent in how you move, consistent and trust. One of the things consistency and strategy does is it takes the emotion and the anxiety of watching your accounts out of the equation. Because what happens is you take a loss. What's the natural response? I got to get it back. That's what. Think about who else does that? Who else sits up and doing good, all of a sudden they take a hit, and the first thing in their mind is, I got to get it back. Who does that? Gamblers. That's a gambling mentality. And if you're not careful, the market will do you just as bad as Vegas. So you cannot allow yourself to get caught up in emotions. One of the ways of doing that is just being consistent in your strategy, consistent in your approach. Even when it doesn't seem like to be, you got to trust that the principles of investing, the strategies that have been proven over and over again, are bear out. And again, you're not going to win every time. You're not going to win every time. You're going to take some loss. The goal is to manage risk and to reduce loss, but you're going to take some hits. Nobody can get it all right. Nobody's perfect. But if you literally balance your diversification, be very strategic, get into something that has compound growth, be very aware of how companies are performing. Pay attention to geopolitical affairs around the world. You need to do a lot of reading. You need to do a lot of study because these geopolitical influences influence the economy. Going to war. Two countries going to war are going to do some things, especially if it's your country. Some things are going to happen when countries go to war. A couple of markets are going to take major hits. Some markets are going to take major hits. Some markets are going to actually grow. Anything that has to do with weapon development, anything that has to do with oil and fuel, those markets are going to grow. Now the prices are going to go up, which is what you want. Why? Because that's how you gain your money. So you've got to be aware of these things so that you can know: do I want to make a shift? Do I want to shift in the rebalancing of things? Another thing is know your natural bend towards risk. Are you risk assertive or risk aversive? Do you have a high risk aversion, meaning that you don't like to? I don't gamble. When I go to Vegas, I used to have to go to Vegas a lot because I own some retail clothing stores. So I used to go there a lot for this thing called a magic show, which was twice a year, and it was all of the urban fashion and stuff like that. And I would go with my business partner, man. He'd be at the tables, I'd be at the quarter slot machine. And I was at the quarter slot machine because I did the math. And I realized if I put $100 bill in the quarter slot machine, that's 400 spins. If I catch a person coming off a slot machine that I watch sit there for a while and spin for a while, and I sit down and I put $100 bill in, I was going to hit before I got up. And worst case scenario, I blew $100 and I played until he finished blowing his money at the table, and we're gonna go do what we got to do at the convention center. And that's how I always. I'm not sitting at no table. I'm not playing no cards. I'm not playing Russian roulette. I'm not shooting no craps. I sit at that quarter slot machine, and I'm gonna take my chances with the math. And normally it pays for my meals, it pays for a bunch of stuff while I'm there. And that was my way of doing it. So I was highly risk averse when it comes to that. I'm not as risk averse, whatever, but I'm not a high risk taker. I'm looking at it, especially at this point in time in my age. I have to be a little bit more aggressive because I'm not 25, 30, 35 anymore. So the things I want to accomplish over the next 15 years have to be done with some assertiveness and some aggressiveness, but it's still very measured. It's still monitored, and a lot of it is truly investing in me now. It's investing in my business. It's growing and building that, but also paying attention to the market. But again, you've got to be able to know your risk. It's one of the best ways to do that. There are so many places. You used to have to, just go through. You were either aggressive, moderate, or conservative. That was how people looked at you, and they kind of just eyeballed how you moved it, whatever. Now you can actually go to a couple of sites, and you can actually take a very deep, a very in-depth analysis, and it will tell you exactly how you are towards risk, and it'll show you how to build and you can learn based on it how to build strategies in investing. You need to know if you're risk averse, because that's going to determine what type. You need to be very systematically driven if you're risk averse, because if not, you'll never get in. If you're highly risk averse, you'll never get in. So you need something systematically that pushes you and drives you and stabilizes you, because you're going to be anxious. Risk averse people are extremely anxious. Everything goes wrong. Oh my God, what's going on? And here's something I tell people all the time. It's hard for me to have a conversation about the market and not share this. This is why I prefer long-term strategies, because it takes the emotion out. But check this out. If you own stock and the value of your stock begins to drop, you have not experienced a loss yet. You're in a market where you're experiencing natural volatility for whatever reason. And what you need to know is what's causing it. How does it look? But you haven't experienced the loss until you sell. It's still your stock. Why am I saying you haven't experienced a loss? You haven't negotiated the stock. The stock is still yours. So what that means is, if the stock begins to recover and it grows back to its original value or even greater, you didn't lose, you won. And that's why you go long term, because they're going to be ebbs and flows, this up and down thing. You don't want to get caught up in all that movement. What you want to be caught up in is working a system and a strategic play that over the long term produces what you want. And yeah, you want to have these things that you get involved in, but they should be hedged by your solid investments, so that even if this thing that you just really feeling I got to get involved in goes wrong, it doesn't take you out. So again, that's my little talk on that. So get the risk analysis. Finally, requiring a margin of safety. What's a margin of safety? A margin of safety is having this certain percentage that the prevailing, say for instance, the prevailing price or the prevailing value of a stock is 80. Then you say, I need a 20%, I need a percentage, 20% safety margin. That means I need I need the intrinsic value, not the prevailing value, but the intrinsic value of that stock to be $100. So at $80, that's the prevailing value. That's what it's probably selling for. You need to be able to do your homework. You need to be able to do the analysis. You can sit up and say, man, it's worth more than that. So then what does that mean? That safety margin is saying that it'll more than likely go up before it goes down, that there's value in it, so that even if it starts to drop in prevailing value, I'm looking at the intrinsic value. It's still there, because it can always grow back to the intrinsic value. So again, that's something you should look at. And it's the same thing in real estate. In real estate, we call it a spread. In real estate, you're sitting up and you're looking for properties that have a list price, right? But you're looking at it, and so you do these desk appraisals, or you have somebody that does appraisals or whatever, and you have them do a desk appraisal or a drive-by appraisal. And what you're trying to do is you're running comps on the cost of houses per square foot with similar situations within a certain square mile. I mean, within certain square miles of that particular property, to get an idea of what it's worth per square foot. And so what happens is, it may be a list price of 300,000, but it may have an appraised or a projected appraised value of 400,000. That's $100,000 spread. Okay, so then you can determine, I'm only going to invest in properties with an X amount of dollar spread or a certain percentage spread, whatever, how you want to do it. And what you're doing is saying, I'm going in with equity. I'm going in with equity. It's real hard to do now because it's a seller's market and they're actually pushing prices beyond what I believe they are. So you can sort of look at pin to prick and maybe see. I don't think it's going to be a big explosion of a bubble or a bubble pop. Again, this is just me looking at it. There are some people who are much better at this than I am, but my evaluation is that it's seeking and it's trying to come back, and if it does, and if things move properly, it'll come back without such an explosion. But be prepared because there's a win on both sides of this thing. It always is. Just be prepared to pay attention to it. But the goal is when it's available. And see, here's the thing: if the bubble does pop, so you got all these inflated prices, right? The bubble does pop, it's going to overcorrect. So guess what? Property is going to drop down below. Property values are going to drop down below what they're actually worth. That's when you buy. That's when crisis investors buy in stock. That's when real estate investors buy in real estate. When what? There are built-in spreads because of the market, and so and especially when you start getting motivated sellers for whatever reason. So anyway, these are just some of the things, but those are the five that I have to give you today. So again, there is so much to learn, and I put it all in the Path to Generational Wealth course. If you want to check it out, the link is in the box. But whatever you do, you need to start educating yourself. Need to start reading. We're going to continue to share these things on Money Monday and Wealth Building Wednesday to help you gain some insight. But what can be shared here is minimal compared to what needs to be learned. Again, we lose because we don't understand how things work. We don't give the proper value to learning that we need to. We don't give the proper value to personal development that we need to. And then we get pushed behind and left behind, mishandled, misused, and we get frustrated. It's up to us to build the value in our lives by learning how things work and so that we can use them strategically to prop ourselves up. So again, if you are helped or aided or encouraged by anything you heard today, hit the like button, hit the share button, subscribe, and follow. If you're interested in taking things to a higher level and learning, check out the resources in the description box. And once again, I thank you guys for joining me. Look forward to more empowering and encouraging information across a number of different spectrums. We're not just talking money, we're talking personal development, we're talking relationship, we're talking health. All of these things are important to live a full and fulfilling life. And I want to share everything that I've experienced, everything that I've learned, everything that has blessed me, everything that I'm aspiring to because I haven't arrived yet, and everything I'm aspiring to so that I can encourage you. On that note, look, I'm going to get ready to get out of here. You guys have an unbelievable remainder of your day. As I always say, I live my life on full so that when I leave this place, I die on E. I challenge you to do the same thing.